I have to ask myself, given the pictures that I'm seeing in the macro economy, with a dollar that's stronger and has strengthened in reality, even though prices have risen faster than the dollar has strengthened, to me, that's a worrying sign. And the fact that the debt levels, the global debt level is at 305 trillion. And I said 350 by mistake in the previous video, but it's 305 trillion to be completely correct. This makes me question things because right now everybody is terrified of inflation. They're terrified of stagflation's return. Those are their concerns. And it's like my concerns don't match yours. I think you're like way more worried about the 1970s and a repeat of the 1970s when you need to be way more worried about a repeat of Black Friday in the middle of the Great Depression. Like you don't, the macro picture right now is just absolutely brutal and people aren't seeing it. I mean, like the irrational exuberance that you've seen of all the stuff, all the shopping that you've seen people go on, and that you as consumers appear to have been on a shopping binge lately, and the CPI numbers and everything that are like really great. Household debt is sky high, you know, household debt. And what do you think? Where do you think all that CPI data is going to come from? That shows ultimately, that consumers have gone on, that they've been shopping, really heavily. Like basically, if household debt, even in the United States, is at 16 trillion, then pretty soon people that have been shopping are going to stop shopping because they're going to have to be paying down the debt that they now owe, which means that you can expect a slowdown, and really no really good way for anybody to intervene to fucking bail people out either, because you know like like everybody is in the same boat, like in that regard. I mean, like the government is loaded up on debt. I mean, households are loaded up on debt. Corporations are loaded up on debt. Everybody seems to owe money that they've borrowed from somebody else, at record levels right now, in such a way that you have to wonder to yourself, like when you're looking at the price levels that are out there in the market, and what people are charging for the goods that are on the shelves, and even for stocks and everything. How how do the fundamentals actually justify the current prices right now when the world is so heavily leveraged and in debt? You know, like where is the demand for all this stuff going to come from, and how is the demand for any of it sustainable in a world that owes this much money? If it's about, and it is about the aggregate demand picture directly. It's exactly about aggregate demand. So all these people that are building these businesses, right? And they're seeing all these returns on their business, and they're thinking everything's good. Look, I'm so happy. I'm so happy. My business is making a ton of money. And I mean, like, even me, I'm seeing goods on my store fly off the shelf almost the moment I get them in. But now I'm realizing something, which is that a lot of the people that are buying this stuff are putting it on their credit cards, you know, in their purchase, and buying it on credit. And with credit, what comes up must come down at some point. So what credit does is it speeds consumption up for a while, but then things dive as a result of it, and consumption patterns slow down significantly. So you're looking at a world that owes a shit ton of money, and is going to have to basically start pinching pennies. you know I can't. I can't, like, where are the buyers going to come from when the buyers are going to be too busy paying off the debts that they now owe? You know, like, where's the demand going to come from when people aren't going to be able to buy this stuff because they're too busy paying off the debt that they now owe their creditors? It's a mess, and everybody's afraid of stagflation, but and inflation, and they're seeing this whole picture that the Fed has engaged in unprecedented action in order to try to hopefully save, you know, an economy. And in the meantime, like, everybody's afraid that because the Fed did this, that the dollar is going to lose all its value because they were educated, or, into the quantity theory of money their entire lives, and they were always told that when the money printers go burr, that's how hyperinflation starts. But what they're not seeing is that, the Fed did that in order to try to stimulate, demand for goods and services in the economy. They're trying to, in the macro economy, in the macroeconomic picture, they're trying to print all this stuff in order to stimulate, consumers to actually go out and spend. And with the stimulus they did, they went shopping, but all the stimulus is basically now spent up. And so what it looks like is like a repeat of the 1920s, and in such a perfect way too, if you think about it, right? Why we were going out and spending our stimulus checks, we felt like we were in the midst of the 1920s, and now the crunch of the 1930s is going to come as people have to start paying off the debt that they took out in the 20s. You know, so what went up and felt really good for a little bit is now going to come careening back down. And I don't see right now why the market would have gone and made the correction that it made to the USD today, because it seems to me like a fundamentally irrational move, because the signals that are showing deflation is coming and that we should be really far more concerned that the fundamentals don't even justify the price levels that we're seeing when people owe this much money. What that means effectively, and all that is pointing in the direction of, like, do you realize this? Like, there's nothing really holding up or underpinning any of this that makes any goddamn sense. When the world is this much in debt, prices should not even be half of what they actually are. And that's the whole problem, essentially. You're going to go through, a period where, because of credit, you have this irrational period of happiness and exuberance, and now, it's time to start pinching our bet, or, like, you know tightening our belt, and lowering our consumption immediately after doing something like that. And I've got a business that obviously, like, our sales statistics are like, right in the past couple of days I've made about 700, and seven, or really more closer to $900 in sales. But now I'm thinking, are my buyers going and buying all this stuff with credit cards? That, because you know what I mean? Like, that's what's going through my head about all this, because household debt is now at 16 trillion, which means there's a lot of people that have been using those credit cards, and now the bill is going to come due, and the whole nation is going to be stuck in this kind of situation. And in that world, I mean, where is the demand for goods and services going to come from when far too many people are stuck paying off the debts that they now owe? Which means, effectively, the longer stuff stays on the shelf because people are too busy paying off their credit, the more that the people that are selling are going to think about lowering and slashing prices in order to get people to come shopping. So you're in a world where all the signs are pointing towards a deflationary meltdown, straight up Great Depression style, that came out of a period of the Roaring Twenties. Like, that's what the macro picture looks like right now, and everybody thinks the macro picture looks like it's stagflation. Sorry,